gonna start recording now. All right, recording now, I think. So, plan for today, right? I'm not gonna keep you long. We're just going to review all of the new material you learned over the last 2 weeks for that new chapter on risk and return, okay? So generally, according to the plan for this whole semester, we're just supposed to meet 3 times online, at the beginning of the semester and once in front of the exams, once before the midterm, once before the final. So these are sort of additional meetings for you guys to have a chance to ask me questions and whatnot. Previously I got some comments from the MOE, Ministry of Education, suggesting I need to have a bit more communication between us going on, okay? So this is on record for the Ministry of Education that's going to review my class as well in future, that I do have these extra meetings in addition to what had been planned at the beginning of the semester. All right, so what we're gonna do today, right, is we're just gonna review. Oh, let me see if I'm sharing. I'm not sharing. Forgot to share. So your screen. All right. So what we're gonna do today is we're just going to review a couple of tests that would be. So that would be test number 8 and number 9 over the last 2 weeks, covering that whole chapter on risk and return. Okay. Just to make sure everybody's on the same page, just to make sure that you don't have any troubles with problems that you had in those 2 tests. Okay. So these are all the problems that we have, and I think I'm sharing. Am I sharing the screen, guys? Are you looking at the problems on Moodle?
Yes, Professor.
Oh, yes, Professor. Thank you. Okay, so let's go through these, and as we go along, of course, if you have any questions, shoot. And let me admit this. Right. Go back to Moodle. So let's just copy this, and we're gonna need Excel, of course. All right. So what do we have? You're considering to invest 10,000 in stock A, 10,000 in stock B, 20,000 in stock C. Stock A gives 3% return in case of a growth, 1% return if no growth, negative 2% in case of a recession. Stock B gives these returns in cases of growth, no growth, recession, and the same for stock C. And we also have the probabilities of these outcomes, right? The probabilities of these states of economy, growth, no growth, and recession. Okay, so the question: how much money will you have if recession actually happens? Okay, so on the exam, most important thing is read the question 2 times, make sure you understand it, everything else should be fine. If you don't understand the question properly, then that's a bit of a problem. So let's read it again, make sure you're going to do this on the exam. How much money will you have if recession actually happens? Right, so think about it. And in this case, do we actually care about the returns that could happen in case of a growth and no growth? How do you guys think? In our calculations to answer this question, do we actually care about any of the returns in case of a growth and no growth? Anyone?
No, Professor.
We don't. Yes, absolutely right. We don't care. So most important thing on the exam, all of these things are pretty easy. You get all of the formulas in the new materials. You get all of the formulas in the PDF files and in the videos. Exam is going to be online, so I'm not going to stand in front of you, stop you from using whatever materials that you need. So everything is going to be in front of you. So it's pretty simple. The most difficult thing is just to understand what you're gonna do, right? Right, okay, somebody else. All right, so yeah, that's all. Understand the question, the rest should be easy. Let's just make out the table, okay? Even though we're not gonna use all of the numbers, because the same numbers are actually also used in other questions. So let's make out the table, right? So we have three stocks, A, B, and C. And we invest 10,000 into A, 10,000 into B, and 20,000 into C. In this case, okay, instead of just working with these numbers, 10,000, 20,000, whatever not, altogether 40,000, when we look at this portfolio of three stocks, okay, for most of the calculations, we will also need something called weights. Weights is the percentage of each of these investments, okay, out of the total portfolio value. So let's have weights over here. Do I have space for the... Okay, I'm gonna say weights here. I'm gonna put the returns over here. Weights equals, that's clearly the amount of money they invest into this particular asset divided by the sum of the amount of money I invest into the whole portfolio, okay? And if I hit F4 for this whole portfolio, as I copy the formula, the weights stay as they are, right? So 25% in each of the A and B, of course, and 50% of the portfolio in stock C. Next, let me have a look at the outcomes or the states of economy. So we could have growth, we could have no growth, and we could have a recession. Those are the only three outcomes. Let me move this up a little bit. And let's look at the probabilities of these outcomes. Growth is going to happen with a 20% chance. No growth, just like a normal gradual increase, hopefully, is a 60% chance. Recession, don't want that, 20% chance. Okay, stock A returns 3.5, 1, negative 2%. So 0.035, 0.01, minus 0.02. Stock B, 4, 1.2, and negative 4.2%. Okay, negative. Stock C, negative 1% in case of a growth, actually. So this is counter-cyclical investment, okay? So perhaps this is some sort of investment into stable industries that are going to do well even in the recession. Bread making, rice growing, or electricity. People are going to need it whatever happens, even in case of a recession, right? All right, so 1% and 2%. Okay, so this is what we basically have from all of this information. And the question is, if recession actually happens, how much money am I going to have? How much money am I going to have? So another kind of a hint on these questions is sometimes it's easy to kind of miss. It's easy not to notice whether the question is about the actual dollar values or whether the question is about percentages. Okay, so in this case, we could have a percentage related question. What's your return if the recession actually happens? Or we could have, as in this case, a question on particular dollar values, right? So the answer is in the dollar values. Relatively simple. Of course, in case of a recession, my $10,000 is going to grow by the 1 plus the return. The return in case of a recession for stock A is negative 2%. Right? Plus, my other $10,000 is going to grow by 1 plus the rate of return. In case of a recession, rate of return is negative 4.2%. Or actually, I could automate this a little bit quicker, just save 3 seconds on the exam, right? So this is the return I'm going to have just from stock A. Let's move the things a little so it kind of aligns better. This is the return I'm going to have from stock A, right? What if I just copy it? Bam, bam, it's quicker. then sum it up, and I'll have $39,780 left out of the $40,000 in case of a recession. Okay, so again, the question is about the dollar value, how much money, not what percentage, not what return, not what profitability, right? So the answer is 39,740. So far so good. Let's switch to you guys. Any questions?
Hello, Professor.
Uh-huh.
Can I also ask one question from last week's quiz?
Yes, but today's plan is to go through the two quizzes 2 weeks ago and last week. So we're going to come back to that. Let me go through over that. Perhaps our plan is just going to cover your question as it is. You know what I mean? So today we're going to go through test number 8 2 weeks ago and test number 9 last week.
Oh, okay.
Right. If you could turn on the camera, that would be good. We're recording this for the Ministry of Education. They told me I need to have more communication with you guys. Okay. So, any other questions so far? Screen.
Also, midterm exam. I have a question from midterm exam.
Okay.
How about the last question about the probability something? Do you remember?
I don't memorize it as it is. Let's have a quick look at the midterm exam. Am I sharing? Where is that? Where is that?
No, Professor.
No. Oh, okay. Not this. Okay. So midterm exam. Right. Oh, that was very interesting. That was very, very interesting. Yes. So, first thing is there was a bit of a. I'm sharing, right?
Yeah.
So
Yes,
first
Professor.
thing is there was a bit of a trick over here with risk premiums, not returns. There is a hint though. So you could have guessed that you need to add the risk-free rate of return to have the actual returns. So you need to work with the numbers of these premiums plus the 2% of return. Okay. Right, so there's that one thing. Then you would easily calculate the average, the variance, that's historical data equals var.s for the sample, same for standard deviation equals stdev.s for sample. That's okay. The most interesting thing, I suspect your question is about that last question in problem 3. Is that right?
Yeah, that's right.
Oh, yes. So this is based on the empirical rule. Remember we had this, let me open Paint. Right. So remember we had this empirical rule that 67% of all data is within one standard deviation of the mean. 95%, right? 95% is within 2 standard deviations of the mean, and 99.7% is within 3 standard deviations of the mean. Okay. Now you got the standard deviation here, and you have the mean here, average and standard deviation. You could have calculated this 5.7%, how far in standard deviations is it from the mean? And if it's, let's say, 2 standard deviations away from the mean, so it's 2 standard deviations either higher or lower, you're going to look at this part of the chart and calculate what's the probability of that. Okay, so this is 95%, the remaining is 5%. But we're not looking at both parts, only one part, let's say positive or negative, whatever it is. It doesn't have to be positive or negative, it's either below or above the mean. And this is half of the 5%. Okay. Let's go back to the tests. That's our plan today. As I mentioned, class is going to be short. You still have to go through today's material on your own. Now I'm going to review all of the last chapter, all over the last 2 weeks. This is today's material. You're going to look at it on your own, tests and everything until 6 p.m. A bit more time for you to complete everything. Now going back to test 8. Test 8, test 8, test 8. Right, so these two questions are similar. What amount of money will you have if a particular outcome happens? Next, the portfolio return. Okay, so we are working with the same numbers. Calculate the expected return of your portfolio. Let's close the midterm. Okay, so we have this portfolio. The expected return of a portfolio. So first I want to calculate the return by outcome. I already got this, for example, as a practice, right? So let's call this return by outcome, or return by state of nature, return by state of the economy, okay? So if the growth happens, then in that case 25% of my money is going to grow at 3.5%, plus 25% of my money is going to grow at 4%, plus 50% of my money is going to go down by 1%. Bam. So if the growth happens in percentage terms, not in the dollar values over here, right, I'm going to earn nearly 1.4%. Okay, so let me try to automate things. I'm going to fix the reference to the weights, F4, F4, F4. Scroll it down. So in case of a recession, I'm going to lose slightly over 0.5%. That's down from 40,000 to 39,740. So these basically tell me the same story. One in percentages, one in dollars. And these are the outcomes by state of nature, or the returns by state of nature. But these states of nature have probabilities, right? So the probabilities times the return by outcome. Okay. Once I add them up, I will have the total portfolio return, unfortunately very low in this case, nearly 0.8%. Okay, so far so good. Any questions? Right, and lastly, because these questions are quite similar, standard deviation. Yes, we want to calculate the standard deviation. Standard deviation. So several steps for that, as you've learned on your own from the materials I posted on Moodle. So that's first step. We want to calculate the difference, okay, between the return by state of nature versus the portfolio expected return. Let's label it. It's over here. Expected return is right there. Oi, what is that? Anyway, expected return is right there. So equals return by state of nature, return by state of the economy over this, I'm sorry, minus this. And we want to fix the reference so I can copy more easily. There it is. Okay. So I'm going to look at all of that combined, of course. Some of them are negative, some of them are positive. So I'm going to take a power of 2 of this difference equals this into the power of 2. Right, very small numbers, a bit unfortunate. Sometimes if you see this on the exam, basically some sort of a big number, in this case 6.5, it's very big compared to neighboring numbers. 6.5 and then very strange E minus 0.6. Don't be afraid, that's absolutely fine. It means that the actual number is moving this decimal point to the left 6 times. So that's 0.000065. That's okay, small number. Okay. So those are the differences squared. Okay. Let's multiply those by the probabilities of each of these states of the economy. Okay, that becomes even smaller, right? And we add them up for the variance. Our actual question is about standard deviation, but let me label it as well. So that's our variance. For the midterm exam, we used equals var.s. Why can't I just use equals var.s in this example to calculate variance? Wouldn't that be much faster? Anyone? Again, before midterm exam, we learned how we can calculate variance. One way to calculate variance, if we have a lot of raw data on the historical returns, is just in Excel hit equals var.s and feed it all the historical returns. A lot of hints here. Why can't I just do that now instead of all of these steps to come to the variance? And I haven't answered the question yet. The question is about standard deviation, right? So I interject with another question just to have a chat with you. Why can't I just hit equals var.s and find the answer much quicker? Anyone? No one?
Professor, can I try?
Yes, let's.
I'm not sure, but I think because we're in this situation, we're dealing with different weights, so we cannot shortcut it with variance.s.
That's partly true, yes. So that's partly true. We have different weights. So if I just feed it some returns, those returns might have different weights rather than all the same weights. But what if I have all the same weights? I invest equal amounts of money in all assets. So you are partly true. So you are correct. We couldn't just do that due to the weights. Another reason, though, is kind of even more fundamental reason. Let me just tell you, is that we don't have historical returns, right? Before midterm, you had historical returns. Imagine you returned this much over these years. What's the variance there? Blah, 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 right? Here, we are looking at projections, right? So we don't even know what we're gonna have, even just from stock A. Am I sharing? Yeah. Even just from stock A, you see, we're like, oh, if growth happens with 20% probability, but the recession happens another 20%. So we're just trying to project into the future. We don't have anything to put into the var.s formula. You know what I mean? So this, I think, is a really good question because it helps you to understand in general, like, what are we doing during this whole semester, right? Instead of just learning the formulas, preparing for the exam. Learning the formulas, preparing for the exam. It's not so great because when you graduate, go get a job as a financial analyst or some other sort of similar position, right? Do you actually see the big picture? Right? You got a task and you need to figure out a way to resolve that task, right? If you just learn the formula, pass the exam, learn the formula, pass the exam, the beginning of the career can be quite difficult. If you understand the general picture, right, then it's much better. All these formulas, you will be able to find them on the internet in the future easily enough, right? So, okay, this was a very good question. I think that helps you to understand the general picture a little bit better. Before the midterm, We looked at historical values, right? We looked at the variance, easy enough to calculate. Now we're looking at projections, right? Nothing to feed into that var.s formula. So lastly, to answer the question was about standard deviation. Easily enough, square root of variance is the standard deviation. In this case, 0.7% or 0.68%. Let me label it. That's the standard deviation. That was our answer. Coming back to Moodle, that's the standard deviation of the portfolio. Standard deviation, okay, done. Next test. Last week's test. Last week's test. Where is it? Here it is. What do we have here? CAPM, or the capital asset pricing model. Okay. And what do we have for CAPM? I guess the slightly tricky part of CAPM is that there are a couple of formulas, right? Depending on what sort of data you have, you might use one formula or the rest, or the other. So another somewhat tricky part of CAPM, right? Another slightly tricky part of CAPM is often the names of required rate of return and expected rate of return are used interchangeably, right? But there are some situations when those names are not exactly the same, okay? So the required rate of return is the minimum rate of return you would have to require based on the level of risk as measured by beta. Remember, beta measures the systematic risk. Expected rate of return, well, you would kind of expect somewhat similar rate of return because that's what people require, all investors require based on the risk. But the actual situation on the market right now, current rate might be different, right? So sometimes the question might be, the stock is returning this much, is it overvalued or is it undervalued, right? In this case, the expected return is what's actually given, and you want to use that CAPM formula to calculate the required rate of return and compare them. Does the stock return more than it should or less than it should? In that case, this required rate of return and expected rate of return have completely different meanings, right? But some textbooks, when they teach about this CAPM, about these two formulas in general, sometimes required rate of return and expected rate of return might be used interchangeably. So, required rate of return, sometimes expected return, right? For the CAPM, risk-free rate of return plus the market risk premium of the whole market times beta of the stock. Let me zoom in. You have that in your videos last week. That was a highlight of the video, right? Another formula for the CAPM is risk-free rate of return plus the expected return of the whole market minus the risk-free rate of return. Actually, this difference between the expected return of the whole market and risk-free rate of return is the risk premium. So that's why these two formulas are the same, multiplied by the beta of the stock itself. Okay, now we can go to the questions. Let's find the expected return. Oh no, the expected return is given. Right. So that's actually relevant to what I've just said right now. Okay, the stock is giving us 4%. There are actually a couple of stocks. Let's read the whole question. So we have two stocks. Risk-free rate of return is 1%. Market is expected to return 5%. Market risk premium is 4%. So in this case, we have too much information. We can use either of the formulas. Okay. Zoom out so I can read everything. Betas of stocks A and B are 0.9 and 1.1 respectively. Expected return, in this case, which is not the required return, For stock A is 4.4% and 5.6% for stock B. Which of the stocks are under or overvalued? Okay. To answer that question, remember the securities market line. Talked about it last week. We have the risk-free rate of return right here. Stocks over here are undervalued. Very strange. Undervalued on top of the securities market line. And overvalued underneath the securities market line. Kind of strange. Undervalued is on top of the securities market line. Why is that? Any ideas? So let me repeat the question. If you blanked out for a second, talking about undervalued stocks and overvalued stocks, to answer that we need to look at the securities market line. If the stocks actually return over here above the securities market line, then they are undervalued, and vice versa. Isn't it kind of strange? Undervalued is on top, undervalued is on top, and vice versa. Isn't it strange? So the question is, why do you think undervalued is on top? Usually underwater is down. Right, while you're thinking, time to check attendance. In the next 30 seconds, can you type your student IDs in the chat? Let's see if I'm recording. I am recording, yes. So just to double check that.
Professor, the stock is undervalued because of expectation was.
Yes. Let's go back to this drawing. Yes, the stock is undervalued. It's over here on top. Why is undervalued? Because the expectation is high. The expectation for the return is high. But why it's called undervalued? I wonder. Any ideas? Yeah, you're right. Expectation for the return is high. Why under is on top? Why under? If it's on top. Or why under is on top? Basically, different coin of the same question. Why under is on top, or if it's on top, why it's called under? Andy, you had a good start. So let's get back to this chat while you're thinking of that question. So let's scroll. I'm recording. Scroll for the attendance for today. Okay, done. Right. Andy, do you want to try why it's called undervalued and why it's on top? Anyone else? Very good question. I love these questions because they're not just about calculating things. They are to help you understand the big picture, really. This is pretty important. Not important for the exams. You can pass the exams with your help with the textbooks and my videos and the formula sheets. But they can help you in the future, at the beginning of your career. What the hell are you doing, right? When there is like no professor to help you out with a particular task, you need to understand the general picture to resolve the problem, right? So this question is also pretty interesting. Any answers? Okay then. It's absolutely fine there are no answers because this question is not easy at all. Okay, it's not really easy at all. Once I tell you it's going to be easy, but to come to this realization on your own is not extremely easy. And the simple answer, the answer is simple, but again, not easy. There is a difference between simple and easy. For example, it's simple, just go to the gym every day and you'll be strong, but is it easy to go to the gym every day? So that's an example for the difference between simple and easy. The answer here is simple because the names undervalued and overvalued are not talking about the returns, they are talking about the prices. If the price is too cheap, the return will be high. If the dividend, for example, you expect is very high and you think the stock price will go like up to $200, if the price right now is only $100, the price is too much down. It's too under where it should be, so undervalued. Okay, and vice versa. If the dividend you expect is very little and you think the stock price should probably go to about $200 next year when things improve, but it's already $199. What are the returns? The return is going to be not so great. The price is already high. It's over. High is over, right? Overvalued. Love this question. Okay. I really like talking about finance in general. So, I forgot what did we have to do. Did we finish with this question? No, we didn't finish with this question from the test, right? So basically we calculate the securities market line, CAPM here, calculate the required rate of return, compare with the expected return and see if it's undervalued or overvalued. So let's do it quickly, we're running out of time. 1% risk-free rate of return, risk premium is 4%, right? So 4% multiplied by 0.9 is 3.6%. Correct me if I'm wrong. 4 times 0.9, yes, 3.6% plus 1% required rate of, free rate risk of return, that's 4.6%. That's required, minimum required, but it's actually giving even less than that. So stock A is over here. It's giving less under the securities market line. Securities market line shows how much is required. It's giving less, so A is overvalued. Let's have a look at B. So 1.1 times 4 is 4.4, plus 1 is 5.4. That's the minimum required, but B gives more, so it's undervalued. Okay, questions? All right, so that's about the valuation. What's this? Okay, expected return, stock portfolio beta is this much, expected market return is this much, premium risk-free return. How much is the expected return on the stock? So here's an example where these names for the returns are used interchangeably. Expected return, we're actually calculating the required rate of return. Pretty easy. We'll just use one of these formulas according to what we have. We have risk premium, so we don't need the market return. We can use the shorter formula. So what's the expected return? Risk premium is 5%. Where is beta? Beta is 1.15. So 5% times 1.15 plus the risk-free rate of return. Where is the risk-free rate of return? 1.5%, so plus 1.5. The answer is 7.25%. 7.25%, or 0.0725. So next sort of question is about the portfolio beta. So we have these investments, okay, different amounts of money invested into stocks A, B, and C, and those stocks have different betas. We want to find out the portfolio beta. The hint here is that portfolio beta is the weighted average of the stock's betas. Okay, so we need to find the weights. The total portfolio value is confusing, portfolio value or PV, present value. So portfolio dollars invested in total is 8,000 plus 5,000 plus 7,000, right? Okay, so the weights of A, weights for B, and weights for C. Okay, which is A is 8,000 over 20, which is 40% of the portfolio. B is 5,000 over 20, which is a quarter of a portfolio, and C is 7,000 over 20, which is 35% of the portfolio. Okay, A has a beta of 0.95, B has a beta of 1.12, and C has a beta of 1.42. Multiply by their weights and add them up to find out the portfolio beta. Somewhere in between. Basically, it should be a weighted average of these numbers. 1.157. Questions? Okay, and last, we already got the portfolio beta. Portfolio stock beta is the same. No, stock beta is not the same. We have the CAPM formula. Okay, let's have a look at this last question. The rest of the questions are all basically the same with different numbers. This last question, zoom out a little. So we have the required return for the stock. We have the risk-free rate of return, market risk premium, market expected return. If we have the risk premium, we can just use the shorter formula. And we don't have the beta. The question is, how much is the beta? So we just rearrange this formula. Expected return, in this case it's actually required rate of return, but okay, whatever name is used, is 10.5%. It's equal to the risk-free rate of return of 2% plus the risk premium of 5% times the beta. So we just rearrange for beta. Beta in this case is going to be equal to 8.5%. That's 2% going to the other side of the equation with a negative sign. Okay, 8.5%. And all of that divided by 5%. Because I divide the whole equation by 5% to get rid of this coefficient in front of beta. Okay, so that should be... Beta is equal to 1.7. Is it really? Let me see the details. Yes. That's all you had to do for tests number 8 and 9 over the last 2 weeks. Today you still have to review all of the today's material. We have the learning objectives for today, as we do have for every week. Again, this is probably to point out to the Ministry of Education as well that I do have that. That's part of the requirement, I think. So, the link to the video explanations, the PDF of the new material, and the test for today. Questions? Questions? No questions? Okay, that is all for today. Thank you very much, guys. Bye-bye.